Section A4, our philosophy. An optimist's guide to savage pessimism. Here's our philosophy about trading. If you find yourself panicking about a recording, oh my gosh, where's the recording? Are you going to record this webinar? Or missing something? Or being filled with the need to ask me right now, how do I whatever? Then just stop yourself. Always ask yourself, if you start to become anxious, walk yourself through the worst case scenario. What if Rob isn't recording this? Okay, well, I'll just ask him to do it again, and he'll do it again. What if I don't find out which stock is the best stock of the day from Rob? Oh, the worst case scenario is I'll have to find it myself. Okay, if you find yourself panicking, okay, you forgot to close the trade. So yesterday I had a buy to close order, and then I closed it with a market order, and I left the buy to close order there, and I got stuck in a buy position on a stock that was falling, and it was a loss. And I was just sort of out and about. I was at a drive-through with my daughter, and we were going to watch Netflix in the car. And I realized the trade was open, and I wasn't near a computer. There was no way for me to close the trade, and I hadn't asked Caleb or Tyler or Rich or Jeremiah or Warren to, get access to my account, and I should do that. So there was nothing I could do about it. The worst case scenario was the stock would go to a zillion, and I would lose all my money, and it would be a lesson that we could all learn about. Like, I just walked myself through that. Now, if I really wanted to, I could ask my assistant or somebody else to log in, but I just knew the worst case scenario really wasn't that bad. It wasn't too big of a trade. Everything was fine. Just talk yourself down from the ledge whenever you get FOMO. So stop it with the FOMO. Stop it with the fear of missing out. Just stop it with that. Stop. Like, if you ever find yourself panicking that you're not getting the same thing that somebody else is getting, if you're panicking that you can't get into the trade as fast as other people, if you're finding that just stop it. Stop it. And then change something about you before you change something about other people around you. I missed the trade this morning. Oh my God, I'm late this morning. I missed the trade. What are we doing? I got in the webinar late. I had to, I don't know, whatever it is. Like, stop. It's your responsibility. It's not anybody else's. Don't worry about it. Just stop it with the fear of missing out. You miss a whole day of trading, there's going to be a whole bunch of crappy companies tomorrow. You're not missing anything. You don't worry about anything. So the last thing you want to tell somebody who's freaking out is to stop freaking out. I understand that. So before you're freaking out, have a plan in place. If you find yourself beginning to freak out about something, stop, walk yourself through the worst case scenario, and realize that you're going to be able to take some steps and you're going to be fine. You must become self-sufficient. You have to become self-sufficient. We will have more millionaires in this program than any other program on planet Earth. There will be more millionaire traders in this program. None of those millionaire traders are going to be people who follow alerts. They're all going to be, ladies and gentlemen, those of you who want to become self-sufficient. I promise it. There's nothing so difficult about this that you can't get it. You must learn to stand on your own. You have to learn to stand on your own. We will stand with you, but you have to hold your own sword. You have to hold your own shield. You have to go into battle as your own soldier. You have to. You cannot expect other people to do the work for you. You have to be willing to do the work. You're going to be fine. Now, here's our philosophy about companies and stocks. Companies that do not make money in the long term have unhealthy stock prices. Oh, here, so that's what I said. Companies that don't make money do not in the long term have healthy stock prices. Companies that don't make money are garbage. If the company doesn't make money, it's not going to have a healthy stock price. Warren Buffett won't buy it. Nobody buys it. Okay. In other words, no stray animals. Okay? You could do it with animals, but no stray animals with companies. You're not going to rescue a bad company. You're not going to say the company's mission is beautiful. They're planting flowers in the middle of the freeway intersections. It's beautiful. The flowers are beautiful. Yes, everybody who plants the flowers will die. The company's never going to survive. Okay? Don't become married to the mission of a company. If Tesla starts losing money consistently, Tesla's a shitty company and you should never buy it. Okay? The companies that do not make money will not have healthy stock prices. This means we're going to look at cash flow, which I will dive into later, and earnings per share. Here's another secret. Most companies do not make money. In fact, like 90% of companies under $5 a share don't make money. So most companies will not have healthy stock prices. The reason you want to be a short seller is that it is an untapped market. I can't wait to show you what happens on Amazon when you Google for books about short selling. I can't wait to show you. Nobody's even thinking about this still. I can't believe it. Nobody's thinking about it. Most companies do not make money. Most companies will not have healthy stock prices. The next time you hear somebody go, the next time you hear a guru or anybody go, buy this stock, and that stock goes up, ask yourself, does that company make money? If the company doesn't make money, you don't want to be caught holding that company. Now, are there exceptions? Let's talk about it. Are there exceptions? What about cutting edge technology? Okay. Fine. Now you own a company that needs more of your money to survive, that has quote unquote cutting edge technology, and they're going to issue more shares, and your shares are going to be worth half as much as they were before. Great. Congratulations. Listen, I don't know how many times I'm going to tell you this. Yes, there are companies that don't make money and their stocks go up, and eventually they do make money. Tesla did not make money at first. Amazon did not make money at first. And you would have been rewarded by buying those companies and holding on to them. Great. I don't care. How many companies were like that? Pets.com, Webvan, Cosmo. Like, how many companies were in the .com? Like, come on. Like, there were a lot of companies at the time. Did you really know the difference between all those companies? It's easier to say there's a giant group of companies that lose money, most of them will fall, than it is to say here's a giant group of companies that lose money, one of them will succeed. You really want to pick the needle out of the haystack. That's really what you want to do, and you want to put that in your portfolio. You're really as smart as Mark Cuban. You're now a shark on Shark Tank. That's what you are. No, you're not. You're a pessimist. And you're a pessimist. And it's better to say, period, it's better to say 100 of these companies lose money. It's better to sell all 100 short than try to find the one. You're not going to find the one. Maybe somebody is. Maybe Paul Scolardi is going to find. He's the best swing trader I've ever met in my life. He's made tens of millions of dollars. I don't want to do as much work as he does. I'm not going to do that. All right. Most companies do not make money. Please wrap your head around this. And I know it's going to turn you into an asshole. It's going to turn you into somebody that nobody wants to listen to, talk to, or have anything to do with. Because you're going to be a pessimist. You're going to be negative. They're going to hate you. People hate short sellers. We're going to talk about the Hall of Fame. Andrew Left, one of the Citron Research. He's hated. They sicked the FBI on them. They found nothing. Bruce Ackman, they hated him when he shorted Herbalife. People hate short sellers. They hate them. The CEOs of companies hate them. You are participating in the destruction of wealth from hopeful people. You are going to be shorting stocks that some people have in their retirement accounts and that some stupid people are holding on to in their bag holders. I don't know what to tell you. Except a company with no cash flow cannot invest in factories. It cannot invest in sales and marketing. If it doesn't have money coming in, it can't invest in stuff. It cannot invest in customer happiness. It cannot buy back stock. What it can do, but it can issue more shares It can. So if a company that's like, look, CYTO. CYTO loses $26 a share. It's right on the tradingview.com screen right here, and I'll show you in a minute. It loses $26 a share. Unless it raises more money with debt, who's going to lend money to this piece of crap company? Unless it gets more debt, that's not healthy, or it issues more shares. So here it has, let's say it has 10 million shares. And it's $5 a share. Okay? And let's say it suddenly decides to increase it to 20 million shares. They're gonna sell 20 million shares to stupid people. The company doesn't make more money. It's the same company it was, but it has twice the number of shares out there. The price of the company is going to get cut in half. It's going to drop by 50%. They just doubled the amount of shares. Now they're worth half as much. Period. If you have a special collection of Hot Wheels cars worth $1 million, special collection, rare, very rare collection of Hot Wheels cars, and then they discover 1 million exact replicas that came off the assembly line, your collection is now worth zero because there's more of them. They're not rare anymore. So that's what that company can do. Once again, it's going to turn you into some, kind of an evil person. But these companies are not worth anything. Now, where do you find the cash flow data? I'm going to show you one place to go that'll work. Go to Yahoo Finance. And then type in Yahoo Finance, the symbol for the company. Sometimes it's fun to look at what the company does and a little bit of description. Sometimes you get lost in some of the articles down here and whatever else. But you can see here, it engages and develops therapeutics that unmet medical needs, commercial products, nasal spray, blah, blah, blah. Okay, fine. So maybe their nasal spray was found to prevent COVID or something like that, and it enjoyed a temporary boost in its stock price. Well, let's look at some statistics about the company. So you click on the statistics window right here in the middle. I should probably highlight this so you can see it. And you're going to see a bunch of information here. First, let's focus on this. Return on assets, negative 49%. Return on equity, negative 129%. Operating margin, profit margin is 0. Operating margin is negative 1,000%. Cash flow statement. Operating cash flow, negative $14 million. Levered free cash flow, negative $11 million. Don't worry about the exact definition of that. They have negative cash flow of $14 million. They have total cash on hand of $372,000. This company cannot survive. It doesn't make enough money. It doesn't have enough money. There's no way this company survives. Current ratio is 0.20. Current ratio, 0.20, means they have 20 cents in the bank for every $1 of short-term debt that they owe. Once again, a current ratio of 1. So look at these days. These are some things you're going to look at. A current ratio of $1 means they have $1 of cash for every $1 of short-term debt. Stuff that's due in the next 90 days. They have 20 cents of cash for every $1 of... They're dead. This company is dead. Now, it might survive, and who knows how they're going to survive. Borrowing money, issuing more shares, whatever else. So, you're going to look at these numbers here. Return on assets. Return on assets means if they buy a factory, becomes an asset or whatever, what's the return they get on that? Nothing. There's nothing to invest in. Even if they had positive cash flow, there's nowhere to put it that will get a return. And they're not going to generate cash because they have no profit margin. Their EPS, their earnings per share, are negative $27 per share. Now, you might say, well, they're just about to come out with a new drug. Okay. Or maybe they really have some intellectual property, some IP, and Pfizer wants to buy them. Okay. Then the stock will go up. Yes, maybe they have something special. Maybe they do. But there are 1,000 other companies like this. One of them, two of them, three of them might survive. 997 of the rest of them will not. So once again, put the odds in your favor. In the back of your mind, right? You're saying, well, don't believe the hype. Maybe it is. Maybe it's not just hype. Maybe this company is going to make $1 jillion. Maybe. Maybe is not a trading strategy. And I'm going to walk you through a worst case scenario. So as a short seller, you're going to become very, very used to doing analysis on the worst case scenario. So let's say you short the stock here at $4.46. And we'll talk about the technical way that you do that. You're making a bet that it's going to go down. So you make a bet. And then let's say that Pfizer announces they want to buy this company. And it's right here. And then it just shoots up here to $20 a share. Let's say it does that. Let's just say suddenly, and there's no warning. There's nothing that you could have done. You didn't have any inside information. Pfizer just pulled the rug out from under you. The chance of that happening is 1 billion to 1. Are you really going to are you really going to let that be a hang up for you? It's just not an excuse. Yes, the worst case scenario is all of a sudden some other company will come in and want to buy this company. I understand that. You'll get you'll get your chance. Usually they report these kinds of deals after hours, times when you're not going to really be holding on to these anyway. It's not a frequent occurrence. Does Pfizer really want to buy this company that's doing this badly? Let's look at, these are just the stocks from just the other day. This is just the group of stocks from yesterday. Rev. The company makes money. And it jumped up from $10.50 to $16, like a 60% gain. It did our pattern, which I will teach you, and then it just dropped. Even companies that do make money sometimes just have no chance of success. Even the companies that do. Alpine Acquisition Corporation. Let's look at the statistics on this. So we go to Yahoo, we scroll down. Operating cash flow, negative 1.7 million. So they have an earnings per share that's positive, but they're not generating any cash. So what happened is they're earning money per share, like on the books. From an accounting perspective, they earned money per share, but then they had to pay it out in debt and stuff. They have no profit margin. They have no operating margin. They have no return on assets, no return on equity, and they have $48,000 in the bank, and they have $2 million of debt. I mean, seriously, if your neighbor had $2 million of debt and $48,000 in the bank, and they were losing $1.73 million a year as a family, you might lend your neighbor money, but you're not getting it back. Don't fool yourself. You might buy this company's stock, but don't fool yourself. Don't tell me they have cutting edge technology. They need a cutting edge CFO is what they need. They need, you should go out and start your own company. The standards are so low for having a company these days. You should go out and have your own company and announce that you have AI technology that finds stocks to short. And the AI technology it's a list of companies that lose money. It's not artificial intelligence. And why are we so fascinated with artificial intelligence? Can we just be fascinated by actual intelligence? Could we do that? Let's look at another company that was on the list. DM, it had a good day yesterday. Okay, DM, been popping off the last few days. Popping off, bro. DM. Well, gosh, Rob, so DM, that popped up there, didn't it? Desktop Metal, let's check them out. Desktop Metal, management effectiveness, return on assets, negative 12%. Return on equity, negative 83%. Net diluted earnings per share, negative $2.16 per share. Operating cash flow, negative $181 million. Total cash in the bank, $184 million. Total debt, $136 million. Okay, so they've got some cash on hand. They've got some cash on hand. Okay, all right. Let me ask you a question now. Knowing what you know about their profitability, which is non-existent, would you rather be holding this stock as a buyer or a seller into the weekend? If I caught you holding onto this stock, would you rather be holding the stock as a buyer or a seller? Which one do you think is more likely over the next 30 days, 60 days, 2 years? What do you think is more likely? The stock going up or the stock going down? The stock doesn't make money. It doesn't have any return. It doesn't have any earnings per share, and it's burning through cash. It's going to go down. Now, that's just being practical and realistic. Now, in the short term, you might say, well, geez, Rob, the company's going up. This is a good company, Rob. The company's going up. Let's say you shorted the stock right here. Let's say you shorted the stock right here because the company doesn't make money and it printed a pattern that we look for. Let's just say you did that. You stop out of the trade when it goes against you a little bit and you move on to the next piece of garbage company. And you laugh and you don't worry about it. And maybe you'll come back to this company and get your revenge, and maybe you won't. But you just let it go. You don't argue with the company. You don't hold on to it. But if you did hold on to it, I'd be less upset with you than if you held on to the buy trade. Yes, it can go up all day. Yes, this stock could get short squeezed and it could go up to $50 a share. Yes, 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 and yes. And now I'm going to show you why I never in a million years would have shorted the stock. You ready? I'm going to look at one more piece of information. Short sellers. The short interest as a percentage of float is 25%. Anything over 10% is high. This means that this stock is already heavily shorted and it's getting squeezed. Anything over a 10% short interest as a percentage of float. Anything over 10% is a risk of a short squeeze. What is a short squeeze? A short squeeze is when there's lots of short sellers betting against the company, which there are on this company. There's a lot of short sellers. A lot of people already betting that this company is going to go down, and they will eventually make all of their money. They will eventually get all of their money. And then the buyers come in and they start buying the stock and bidding it up and up and up. So as it goes up, the buyers get squeezed. Stop out here, they stop out here, they stop out here, and they stop out by buying the stock. When you close your short position, you buy it back. And by buying the stock, it makes it go up, it makes it goes up, it makes it go up. So let me ask you a question. Did GameStop stay at 400? Did AMC stay up in the 100, whatever it was? All these stocks that got short squeezed, what do they eventually do? The short sellers eventually win. The short sellers get their money. Eventually, the short sellers get every single dollar that's owed to them. You don't have to worry about that. You don't want to hold on to it. You don't need to. You don't have to hold on to it. You just need to know you're going to be right about it. What has happened every single time Desktop Metal has gone up? It has dropped. What do you think this company is going to do when the stock price goes up to $4 or $5 a share? They're going to dilute their stock. We will be waiting and watching. But we know how to filter companies. We know how to analyze a company. And that's our philosophy of how to analyze a company. We're going to look at return on assets. You can also use return on investments, ROI, return on investments, capital spending. You're going to look at EPS, diluted is fine. You're going to look at cash flow, and you're going to look at current ratio, and you're going to look at debt. You're going to look at all those things. And last of all, you're going to be very careful about any stock with short percentage of 10% or more. Those stocks can be squeezed. Okay, I'll pause here and take some questions. All right, I'm ready to take some questions. What site do I like for doing this analysis? Yahoo Finance, the one we've been talking about. Does the risk to reward ratio change when I do these trades at all? What am I looking to risk versus what am I looking to make? Great question. I'll do a short answer to this, and then when we get into the strategy, we'll get a little bit deeper into it. So when I'm looking to short here, right here on the break below this level at $4.46. Remember, we'll get into the system later. I'm going to have a stop loss above those highs at $5.20. So let's just call it a 60 cents plus 20 cents. So an 80 cent stop loss. Profit target's down here at the 200 SMA. And that is $2.80. So that's about, $1.80 of reward for an 80-cent risk. I'm fine with that. I'm fine with a little bit of a skewed risk to reward ratio. I'd be fine risking $1 to make $1 on these. I'd be fine with that. Richard says, how long has short selling been around? I don't know. I think the founder of the Dutch East India Company got forced out, and then he shorted his own stock back in really long ago. Diego, how quickly can a short percentage of float go up from 10 to 20? Can it happen in minutes? No, it cannot. It takes longer for that data to get out. It doesn't happen that quickly. Is shorting the same as taking your profits before the stock price drops? No. So Tony asked a question. So Tony, let's back it up for a second here. Tony. Okay. I'm gonna back it up, and I'm just gonna make sure we review this. Tony. Stop what you think shorting is. Shorting is watching a terrible company go up, pressing the short button on your platform, waiting for it to drop, and making money if it drops. Tony, does that help you out? Let me know. All right. Judith, are there indicators like technical analysis in shorts, or fundamental analysis is all that you need? Yes, we use technical analysis also. Okay, perfect. Perfect. Great. I got Tony's questions answered, and I'm now going to pause the recording, and we'll move on to the next lesson.